expected and just makes good business sense.
Okay, good afternoon, everybody. My name is Erez Bahar, and I lead the Davidson & Company. Today it is January 17th. We're actually filming this today and broadcasting it tomorrow on January 18th. And for most of you who woke up this morning in Vancouver, unsurprisingly, you saw a lot of snow. And so we have a small, intimate audience in front of us here and a much larger audience tomorrow who will view it online. And so please bear with us as we adjust to the current conditions out there. The good news that we all anticipated, I mean, I think everybody had a warning that it's going to snow, and most people sort of half knew what to do. Of course, our speakers who are here in person have generously taken extra time today to come here, and we're very thankful for that. Andy, who lives a little bit further away, did not make it in today, but he is participating as a recording. And so Andy, when you're out there, we miss you here in person, and thanks again always for your support and participation in the seminar. The nice thing about this morning was there's lots of snow, and I personally got an hour or so to play with my kids and make a little bit of an igloo. Then my foot fell asleep because it just froze too much because I don't really have good shoes for it. But so far I feel pretty good, and the foot has woken up again. And I guess we all predicted to be a very mild winter, and it was up till now. And so whatever your belief are, the weather certainly is unpredictable. And it looks like it'll remain like this for a couple of days. So hopefully everybody who's hearing us is tucked away nicely at home, except for the few people who are brave here to make it and are enjoying the weather and playing around in the snow, which is always a nice thing to do. So on behalf of Davidson & Company, we'd like to welcome you to our annual regulatory and TSX venture update. We do this seminar annually, and without counting the precisely number of years, I believe we are approximately anywhere between 6 to 8 for doing this. And a big reason why we do this is to get representatives from various regulatory bodies as well as the stock exchange to reintroduce themselves, what their roles are in public markets, some of the things that they are seeing from their perspective, whether it's the stock exchange, the Securities Commission, or our audit regulator, to give you, the audience, a bit of a feel on how to be also ready with your public filings to gain knowledge about the different roles of the professionals that are involved in public markets, and also to be able to ask some questions about current hot topics that you may be wondering about, and to allow you an opportunity to get some of those questions answered. 2023, as it's been in 2022 and 2021, have been pretty remarkable years. By and large, significant effects of the pandemic are over, although there are still some lagging things that are still happening. The venture markets, the junior emerging markets, have been softer for sure for 2023 after a pretty significant boom that occurred during the earlier part of the pandemic, when the stock markets were quite volatile and by and large increased significantly. And now we're sort of going through this period where, as you will hear from our various speakers too, there's a little bit less activity out there in terms of transactions. You know, the firm, for us, we're generally pretty optimistic people. We have seen cycles throughout the last 20 to 30 years that go up and down. And in those times when people feel that the markets will never return, there's always surprises. We believe that the first half of this year will still be quite soft. We also believe that as interest rates start to potentially come down towards the latter part of the year, we predict that we're going to have the roaring 20s again, starting in 2025, all the way around 2029 or so. And sometimes, at least from our firm, we believe history repeats itself. 100 years ago, there was a lot of different issues out there in the world, but there's also a lot of similarities. And then the roaring 20s came back. We also are hopeful that there's not going to be a big crash at the end of the decade. But there seems to be a lot of forces out there and a lot of sectors out there in our world that are there now. You know, if you think about 15, 20 years ago, mining was a primary driver for public markets in Canada. Then a number of emerging markets have come along, such as the cryptocurrency, such as cannabis. And now, of course, artificial intelligence is becoming a big driver of conversation, which is also leading to a lot of other potential technology deals. So with that, having a diversified marketplace where there are many industries that are active rather than just one industry can really create an exciting time for everybody. And it's important that all the professionals that are surrounding the public markets are gaining sufficient amount of knowledge to be able to adapt to the different industries that are out there right now. Because while there are similarities in security laws and accounting rules and auditing rules, there are certainly a lot of nuances and differences as you adopt to the sector. So that's our comments here at the firm. Just a couple housekeeping items for us. I'll introduce the speakers in a moment. I'm sure many of them will be happy to answer some questions that you have today and after the seminar. We have found them to be quite reachable and wanting to help the marketplace answer any questions you have. When you do participate in this, please fill out our survey. It's really helpful for us to get some feedback from you on what you like to see and what you'd like to see better done. And then for those of you who attend the course, we will send out a certificate for you to claim PD. And I believe also for lawyers who have to do PD requirements, I think you still do, right, Virgil? Right? So you probably have lots of PD, but I remember the days when lawyers needed PD and they were relying on accounts, but you probably have lots now online. But this does qualify for you as well. You know, a couple upcoming events that our firm is participating in as well is the Vancouver Roundup, which is actually happening this weekend. We have a booth. Please come and say hi to us. And we always participate in PDAC in Toronto as well, and we have a booth there as well. So please come say hello to us, and if you have any questions, we would love to see you there in person. So come by and say hello. All right, so I'll briefly introduce our esteemed speakers who made a lot of effort to come here today, and we're very, very thankful that they took some time away and are able to participate in us to disseminate information to you. From CPAB, which is the Canadian Public Accountability Board, and that is the organization that regulates the auditors. And you'll find out shortly why, even though those are audit regulators, why it's really important for public companies and the rest of the stakeholders to understand the role of CPAB and why audit quality and the maintenance of audit quality is really important for all of us in healthy public markets. Joining us today is the CEO of CPAB, Carol Paradine, and the Regional Vice President of the West, Haiti Scorgi from CPAB. So thank you both for attending today. From the British Columbia Securities Commission, here on my left, we have Anita Sear, who's the Chief Accountant of the British Columbia Securities Commission. And joining us new this year is Larissa Strew, who's the Manager of Corporate Disclosure from the British Columbia Securities Commission. And live out there, Andy, wherever you are at home watching us, and thank you for the recording, is Andy Creech, the Managing Director for Listing from the Toronto Stock Exchange Venture. Many of our panel members are repeated guests and have been here for years, and I know Larissa, it's your first time with us. Both Carol and Haiti and Anita have been with us, and Andy, of course, has been with us for many years. Again, we're very, very super thankful for their continued participation. So the format that will happen here now is that CPAB will come up and give you an update, and then it'll be the British Columbia Securities Commission, followed by the Stock Exchange, and then we'll do a Q&A panel discussion up here, and if there's some time left, we'll kind of put through some last remarks. All right, so first off, again, the CEO of CPAB, Carol Paradine, to come up here and introduce CPAB and let us know what's happening with CPAB. So, Carol?
Well, good afternoon, and thank you, Erez, and the team from Davidson for inviting us again to attend your annual update. Really appreciate the opportunity to be here, and I don't mind the snow at all. I feel at home. Geez, you know, a lot has happened in the last while sometimes we think about auditing as being boring, and I never find it boring, but if you think about all the things which are going on right now, that Erez mentioned some of that, the new technologies, artificial intelligence, we've got a different economic environment than we've had in the past. We're dealing with items like climate change and impact on financial reporting and some of the geopolitical issues which are out there. So that backdrop, want to spend just a very brief time talking about CPAB, a very, very brief overview on that. Some of the things which are top of mind for us at CPAB and things that we've dealt with in the last year. Key priorities as we go forward into 2024. And then I'll hand it over to Haiti, and she will talk about what's coming up in terms of what's been happening in the regulatory assessment side. So we're the public company audit regulator in Canada, charged with protecting the investing public's interests. And our work really includes a variety of things. Much of it is about our oversight of firms. So that's inspecting audit files, but it's also looking at the systems of quality management which are in place at the audit firms. We engage with stakeholders, and that can be anywhere from investors, audit committee chairs, quite a lot of activity with audit committee chairs, with CFOs. Part of that because it's so important that the various players in the ecosystem coordinate, share perspectives, give their point of view on things. And we'll issue thought leadership, not all that often. If you're subscribed to our mailing list, you'll find that things come out maybe several times a year, in particular on the topics that we see as emerging that may not yet be addressed, but we think we need to reinforce a particular point on. And we're involved on a number of international committees. I'm on the board of the International Forum of Independent Audit Regulators. I won't use that name again in the presentation, I promise. But the types of things that we're focused on is we're leading the technology task force there. We're involved in a number of emerging issues because many of the things that we see here in Canada are also issues which are occurring in other jurisdictions, and we can address them in a coordinated manner between regulators. So it was our 20th anniversary last year. And so many of you may think back in history and go, geez, that time's really gone quickly. Think about the formation of CPAB at the time when Enron and WorldCom occurred in the US, and our counterparts in the US were formed, the PCAOB, and the decision in Canada that putting an independent audit regulatory body in place was appropriate for public companies. And we do believe that we have been a catalyst for improved audit quality across Canada in our activities over that period of time. And we look at a variety of measures and key performance indicators in that, and I'd be pleased to go into some of them. But one of the things that Canada should be proud of is the level of inspection findings compared to the rest of the world is typically around half these days of the inspection finding rates in other jurisdictions. But there's still more work to be done. World's changing, new technologies, et cetera. And so what we will do is highlight some of the things that we tend to focus on, areas where we're seeing some problems. Now, the other positive part is we've seen the firms across Canada make very significant investments in the areas of their systems of quality management. Much of it was before the recent changes in the standards internationally came into place, but also as a result of the new standards as they implemented it. And we've certainly ourselves implemented stronger enforcement protocols, and we've been starting to provide greater visibility to investors and other stakeholders related to the enforcement decisions that we make. And of course, one of the areas that we're involved in is also influencing the standards. And pretty well all of the standards we're involved in are set internationally. So that really is the role that we play with IFIAR and other groups on the international standard settings, and ones which are coming out over the next while, like changes to the fraud standard, changes to the going concern standards. On fraud, as part of our 20th year anniversary, we thought about what would we like to do and talk about, and we went back to the topic of fraud because it has such a fundamental impact on investors if there is large-scale material financial statement fraud. So we held a symposium in September, invited a number of really interesting speakers to that event. I was very pleased with having about over 150 people attend the event, some very insightful discussions from a number of stakeholders. So we heard from investors, we heard from audit committee chairs. We had the SEC chief accountant speak, and he tends to be a bit provocative in his comments. But he does say, and I like his comment, and I'll read to you, the auditors assume a public responsibility and owe ultimate allegiance to investors. We heard from FinTrack's CEO talking about money laundering and building a bit off of what happened in the Cullen Commission here in BC and other activities that they have underway. Good discussion on greenwashing and how that relates to climate reporting that we have out there right now. And several of the audit committee chairs reflecting on their views on what more they could be doing as audit committee members as it relates to fraud. And I think, Anita, in your presentation, you may touch on that a little bit as well. Systems of quality. By the way, on the fraud one other comment on that is, if you look at it today, I talked about economic uncertainty. Some of the other factors which change fraud risk at the moment, remote working, both at the company level, but at an auditor level, and assessing what the implications of that are. And these new technologies, they can be very enabling, but they change the fraud risks in an organization. So systems of quality management between December of 2022, December of 2024, the putting in place these systems, if they weren't already in place, the testing of them has all been going on at the audit firm. So for most of the firm's clients, they don't see the implications of this, but it is a very, very significant undertaking that many of the firms have been putting in place. We've been testing a subset of this for the last 6 years, and we started off at the 4 largest firms in Canada on a voluntary basis on it. We moved to the 5th firm on it. We've now moved to all of our annually inspected firms and testing those systems. And it's a really interesting one. It varies significantly from firm to firm. It's not something that there's one set rule for everybody. And what we found is the ease of implementation does depend on how centralized a firm happens to be, what sort of centralized processes. And what I mean by that is, do you look at client acceptance and continuance together as one organization, or is it each partner who does that within their own client list? And do you manage resources within an audit firm overall, or is it done individually? And what do you do when you've encountered a situation where there's a new challenge in an audit, there's been a big acquisition or something like that? How do you know about that and then redeploy within the firm additional resources? So those are the types of controls that we've found particularly interesting as we've gone into this work. One of the really important aspects of this is firm culture and firm governance. And so the culture aspect, it's nebulous, but are the right behaviors rewarded within an audit firm? How does the performance evaluation system work within an audit firm? And that's rewarding good behaviors, good quality, the various things that you're expected to do, and your focus on your responsibility to the public markets. And I get that that can be difficult because the firms also have a profitability and a growth incentive. So considering those biases that you may have, and how does that impact your ability to protect the investing public? So shortage of auditors and auditor appointments. So the good news on this one is every firm I've gone to visit recently have said it's gotten much better in the last while, that the retention levels are much, much stronger this year than they were a year ago, and that they are not having the same challenges in terms of recruiting individuals. That said, they're confident going into this year. I continue to hear, and I do agree, that the longer term demographic changes and trends are concerning. So if you look over the longer term, the level of retirements, the number of students coming in at a high school interested to go to university, studying to be a CPA, that's down. We don't have the exact numbers on that, but anecdotally, a number of organizations are speaking about the implications. Immigration impacts it. The level of people staying within the profession And so the challenges that need to be looked at include things: what is the culture at an organization? How does it support work-life balance? What are the expectations of a younger generation? All sorts of interesting things. Diversity and inclusion also come into it, and so there's been some interesting studies in the US on that topic. Related to that, has it been an issue that we've heard from several audit committee chairs on, was auditor appointments and difficulties identifying new auditors if they decide to go out and look for a new auditor, or if their auditor resigns. And so it's something that we've been tracking pretty carefully. The number of reporting issuers in Canada without an auditor at any point in time this year was ranging between 10 to 20 reporting issuers, and that's across Canada. And we have 7,000 to 9,000 reporting issuers across Canada. So we don't view it as being an alarming number, but it's certainly something that we continue to monitor. And it's a good discussion to have with audit committee chairs who may have in the past found it relatively easy to go out to the market and get 5 or 6 firms, say, bidding on their particular audits. So a bit of a different environment on that at the moment. And by the way, we do understand this has happened for a variety of reasons. It can be limitations in resources which are there, it could be risk management, it could be profitability issues. But either way, it can be challenging, and we certainly understand the issues that are being faced both by management and audit committee chairs on that. So climate, I could spend a whole session talking about climate. I will not. A couple of quick comments. We've been involved in factors like, what will our role be as it relates to the regulation of any climate-related mandated audit areas, or areas that aren't mandated but where audits are being performed. We've also performed a thematic review in the last 2 years on climate in the audits, financial statement audits, and some of the implications, and we've published on that over the last couple of years. We've looked at the new proposed standards as it comes to assurance, and by the way, they're really extensive, and if you step back and think about it, they're actually trying to put into one standard all of the stuff we know about auditing and make that agnostic in terms of what type of professional does the work. So trying to write it so an engineer or a lawyer or a consultant could also do the work. And those of us who are CPAs think about the years of training and background and understanding that you need to put into that to then apply that. So it's going to be really, really interesting to see, first of all, how they come up with the final standard. Secondly, how it gets applied and the level of consistency in the application as these sorts of changes roll out. I think as we talk about it and the discussions we've had with other regulators in the Canadian setting, very focused on proportionality and thinking through the potential risk of undue burden on the smaller companies in particular within the Canadian setting, and ensuring they have the opportunity to build capabilities in this area before requiring disclosures. CPA separations, I put down there Canada and Ontario and Quebec. It doesn't have a direct impact on CPAB in terms of the operations that we're involved in, but we've been considering what are the implications to audit quality if there is a separation. And it raises questions to us around, well, what happens with the funding of standard setting in the future? How will emerging issues be identified and addressed in a timely and a coordinated manner across our provinces? The education programs, there's been press around how the CFE, the national exam processes, will work. And we think about the emerging industries and how they've been handled in the past and how that will work in the future. So certainly a number of considerations as we look at the implications as it goes forward. Okay, so looking forward to 2024. Well, everywhere you open the paper, you're going to hear about technology artificial intelligence, GPT, and it impacts all sorts of areas in the auditing world. Companies are utilizing technology in a way that's very different than they did before. The auditors are using technology. They're deploying, and you've seen news articles about multi-million-dollar investments in different types of artificial intelligence, et cetera. We've issued, by the way, a couple of papers on these topics. Some of them a little cautionary, of course, because that's part of our role here, is to say, listen, if you are using ChatGPT to do this, think about confidentiality of the information. Think about how you've ensured that what you've pulled together using the research through the internet, et cetera, is actually evidenced by facts. Is your research supportable? Is it cited, et cetera? And certainly as an international regulatory group, it's one of the top issues that we are looking at, and we're spending time with a number of the firms around what they're rolling out. So potential areas which will be greatly enable audits, allow you to assess a much larger data set in a more effective and efficient manner. But when you go through the process of these changes, there's some bumpy sections that will happen, and certainly one that we want to be proactive about. By the way, on the audit committee side, we've been hearing from quite a few audit committee chairs about how they're putting policies and procedures in place around the uses of these technologies within their own companies as well. So something that you maybe want to ask some questions about. How do you ensure that the data is accurate and it's reliable? Smaller audit firm quality. In a nutshell, we're concerned that CPAB and others in the ecosystem are not doing enough to support the smaller audit firms to proactively help them with their audit quality challenges. So as a regulator, we'll often apply enforcement, we'll have some publications out there, et cetera. So it's not that we don't do anything, but here in Canada and worldwide, we're seeing, in some cases, increasing audit quality challenges. And it's not every small firm, but there have been trends in that area. And the root cause analysis, I think, is really important to understanding what's been happening. Things like access to specialized resources, general resource challenges, the attractiveness of the profession, the guidance and training that's available to smaller firms, lack of clarity in standards and guidance. And then just the things like the increased use of technology in businesses. Auditors need to retool their skill sets. We're seeing some unusual things at times as well. For example, decentralized audits where audits are being performed by a loosely connected group of contractors, et cetera, in various parts of a country or maybe in various parts of the world. It's new models possibly emerging out of the pandemics, but that certainly make for a different approach to the audit and raise potential challenges like how do you understand the business of the entity that you're auditing. And what we want to do in 2024 is work with some of the audit firms, other regulators around what potential remedies are there to it. Last but not least, our disclosures. So we started disclosing increased enforcement items during 2023, starting January 1st of 2023. That was the phase 1 of our disclosure project. And by the way, I've had a number of questions about why are you guys doing this? And so just to back up a bit, we had been hearing from a number of years from investors, audit committee chairs, that they wanted more information, that they felt we were not transparent, and that they needed more information about the audit firms in order for them to be able to assess audit quality and make the decisions that they need to make. And so as we looked at, well, how could we put things in place, we also did assess, do we believe that additional transparency would assist audit quality? And I think at the end, while there can be bumps along the road again in this area, overall it does result in a quicker response on areas where there are audit quality challenges. So for this year, what we're in the process of doing, we just completed a consultation, public consultation, received the feedback, have analyzed it, related to 2 more aspects of transparency. One is we already provide, in many cases, the reports on an individual reporting issuer to the audit committee chair and the audit committee of that entity. And that's done through a voluntary protocol. For example, with Davidson, they provide that to their clients. It doesn't happen with all of the audit firms. It's been in place on a voluntary basis for a number of years now. We haven't encountered any significant issues related to it, and we felt that it should actually be mandated so there wasn't missing information to audit committees. The second one is the publication of firms' inspection reports, so the aggregation of the inspections that they performed. And in our consultation, we gave an example of what that type of a report would look like, pretty similar to the US one, but with consideration to some of the differences that you could get in Canada. For example, small number of reporting issuers. If you started to give which geography, which industry, you might be able to identify the company. And one of the things we want to be very careful about is not inadvertently identifying reporting issuers. So as part of that process, we're working with the securities commissions and other relevant parts of the legislation, depending on which province you're in order to put changes to the rules that we have in place. We're optimistic we'll be able to get this completed by the end of 2024 to have in place by 2025. But there are a number of steps that we have to go through in order to be able to complete that. And so with that, I'm going to hand it over to Heidi, who will provide a little bit more on the recent inspection trends.
Good afternoon. It's really great to be back at this event with Davidson and Company again this year. As Carol mentioned, I will share with you our regulatory oversight insights, and then I'm going to share with you some key themes that have come out of our 2023 inspections. So each year, CPAB performs inspections of audit firms that audit more than 100 reporting issuers. Currently, there are 13 firms in this group, and they audit approximately 90% of the market capitalization of reporting issuers in Canada. So we typically inspect about 130 files per year. So you may say, Heidi, how do you go about selecting those files? Well, it's based on a risk-based methodology. And what we do is we focus our model to be more biased towards higher risk areas within an organization or a public company, or areas where the firm may have less expertise. And what's important here is that the sample of inspection should not be extrapolated across that firm because it's not a representative sample of that firm's audit work. As Carol mentioned, most firms like Davidson and Company share our engagement specific findings report with their audit committees, and we really encourage the audit committees to discuss these specific findings with the audit firm. So now I'd like to touch on some of the key themes that have come out of our 2023 inspection, and this was issued as part of our fall inspection report, which was published in October of last year. What I'll also do is just provide some questions that you can think about from an audit committee's perspective that you may want to raise with your audit committee or at your audit committee. There were 5 common areas that came out, and those relate to audit risk assessment, service organizations, audit documentation, supervision and review, and somewhat surprisingly, inventory. So with respect to risk assessment, a revised audit standard was introduced last year, and really the intention of this standard was to drive auditors to perform more robust risk assessment procedures. Now, we saw many files that actually did have really good procedures, but the unintended or side effect of this was we saw some really unusual judgments arising in other files. Specifically around the assessing risk area in the area of low, and as a consequence, a drastic reduction in the amount of audit work that was performed. So an example that I can share that we came across was a company with a significant number of subsidiaries, and when you looked at the audit risk scoping, what you noted that a number of those subsidiaries, let's just say when looking at or testing the revenue balance, a number of the subsidiaries weren't actually tested, and their revenue balances were multiples of materiality. So as an audit committee, what you can do is ask your auditor some of the following questions. Were there any areas of your audit where you rated the audit risk as no risks of material misstatement, and why was that? And then in your audit planning, you come to an initial risk assessment, which may evolve during the audit. Did you have any of those kind of instances in your audit, and what was the outcome at the end? The second area relates to service organizations, and we've communicated this several times over the last few years, our concerns in this. And this is where a reporting issuer uses a third-party service organization to, for example, process many transactions for them. Now, in too many cases, the auditor does not understand that they should not just be obtaining the service organization report and putting it in the file, but there are actually procedures that need to be done around the controls at that service organization which impacts that auditor's opinion. An area that you could potentially raise at your audit committee is at your company or reporting issuer, do you have an inventory of all the service organization reports that you're using? Have control reports been obtained, and have they actually been assessed in terms of the impact on your company? And these could range from, say, Ceridian, where you may be using that for your payroll data, to a network management organization. Next, I'll deal with both audit documentation and supervision and review. And the quality of audit documentation has been a recurring issue for a number of years now. But what it does do is it raises concerns around the extent and effectiveness of supervision and review of more senior members on an audit engagement team. And we've observed this year an increase in the number of instances where insufficient audit documentation related to the nature, the timing, and the extent of audit procedures, what the results were, and what evidence was obtained, and where significant professional judgments were made, how those conclusions were documented and reached. The final theme relates to inventory, and what we've noted here is that where a reporting issuer is no longer performing a year-end inventory count, but more perpetual inventory count throughout the year, or a cycle count as others might know it as. In these circumstances, the standards are quite clear around what audit procedures auditors need to do. And as an audit committee, what you can do is you can ask your auditor how they evaluated the effectiveness of internal controls around these counts throughout the period of intended reliance. Now, Carol mentioned some resources, and I'd like to just take you through three aspects where you could look for additional resources in terms of what we've spoken of today. And we really actively identify challenges that auditors may be facing and provide our perspectives on key issues relating to high-quality audits. So these publications, along with other resources, you can find on our website, and those would be, for example, our annual and our interim reports, and that you can find under resources. We also have a newsletter called the CPAB Express, which you can subscribe to, and I promise you we will not spam your inbox. But this really covers upcoming events, publications, current and emerging issues, as well as international regulatory developments. Finally, we meet regularly with audit committee chairs, with directors and management on a one-on-one basis. Please contact us or speak with Carol and I after the session if you're interested in meeting up with us. And then finally, just to thank you for listening to us today. This concludes our portion of the presentation. What I'll do is now pass over to Anita. Thank you.
Hi everyone. Thank you to everyone at Davidson for organizing this event, taking care of all the logistics. So in addition to myself and Larissa, joining us here today is John Hines. He's the Director of Corporate Finance. He's here as well, so make sure to come say hi to all of us at the reception after this event. I think you'll be able to find us. As Rez mentioned, we're a small group, so we can't hide anywhere if you have questions for us. So at the BCSC, the Chief Accountant's Office is a part of Corporate Finance Division, where staff review offering and continuous disclosure documents to ensure that investors have the information needed to make an informed investment decision. So in addition to some accounting issues that I'll discuss further, I'll pass it over to Larissa to start with some common other disclosure issues that our securities analysts have found this year.
Hi everyone, and thank you also to Davidson for extending the invitation to speak here. As they mentioned, it is my first time speaking on this panel. So as Anita said, my group is corporate disclosure, and we are responsible for reviewing all of the prospectuses for BC-based issuers. So as mentioned earlier, financings are a bit down, and we've seen that with prospectus filings in the last 5 to 6 months, definitely a bit down, although we did have a bit of a pickup in December, particularly with base shelf prospectus filings. But who knows what's going to happen over the next couple months. So today I'm going to talk about, I'll just go to the next slide here. I will talk about a few of the common recurring issues we're seeing in our prospectus reviews. The first one is primary business. So in spring 2022, we published new guidance related to the financial statement requirements for primary businesses. The purpose of the guidance was to provide more clarity on the requirements and to ensure that our guidance was harmonized across the country. It's important to note that the requirements themselves never changed. Essentially, if an issuer makes an acquisition and that acquisition is the primary business, the issuer must include in the prospectus the same financial statements for that acquisition as they would for the issuer itself. So some examples of when we would consider an acquisition to be the primary business are for an acquisition that is 100% significant, for an RTO, and for an acquisition that results in a fundamental change in the primary business of the issuer. So an example of this is where an issuer discloses in the prospectus one type of business, but then completes an acquisition shortly before the prospectus is filed. And when you read the whole prospectus, it becomes quite apparent that the business going forward is really that business that they just acquired. So that would be their primary business. A second common recurring issue is insufficient proceeds and resources. So this is something we see on long form prospectuses, short form prospectuses, and even in life offerings, which I'll discuss later. So we can't issue a receipt for a prospectus if the issuer does not have sufficient resources on completion of the offering to continue operations and to accomplish the purpose of the offering. So CSA Staff Notice 41307 has a lot of useful guidance on this. For issuers that do not have sufficient working capital before filing a prospectus, they will typically have to set a minimum offering amount for that offering, or raise more funds privately before filing a preliminary prospectus. We're usually looking for an issuer to have sufficient funds to last a 12-month period. A third common issue we're seeing in prospectus reviews is insufficient financial history. So it arises in long-form prospectus filings for new listings. We repeatedly see issuers filing long-form prospectuses where they've only been incorporated for less than a year, sometimes 3 or 4 months long, like 3 or more months since incorporation. They will include audited annual financial statements, but they're for a very short period of time and very little activities occurred. So we generally raise public interest concerns in these situations. Section 5.5 of 41-101 CP provides more guidance on this. In some cases, the issuer ends up withdrawing the prospectus and refiling at a later time, or they end up needing to audit a more current period. I'll turn to a couple of the recurring issues we're seeing on our continuous disclosure reviews, as the corporate disclosure group also reviews all continuous disclosure of our BC issuers. So the first one is related to issuers who issue a significant number of shares for assets with little value. So here's a typical scenario. An issuer acquires a private company or an asset and pays for it by issuing a significant number of shares to the vendor. There's usually limited information disclosed about the acquired company. Typically, it's a recently incorporated company. Often the acquisition is tied to promotional activity, and a common theme is that the subsequent audited financial statements show the assets as being written off or its value being significantly reduced. Generally, these acquisitions raise both disclosure and public interest concerns. The disclosure of the assets is weak, the value is unsubstantiated, and very often these acquisitions require a business acquisition report, or BAR, which is never filed. So Anita will go into more depth on the related accounting issues later. So as I mentioned, in these situations, the BAR is usually not filed. So just a reminder that an acquisition may constitute the acquisition of a business for securities law purposes, even if the acquired set of activities or assets does not meet the definition of a business for accounting purposes. This comes up all the time where, we go after a BAR and someone comes back and makes that argument, and then we have to explain to them. And this is in our companion policy of 51-102, more guidance on this. Another big issue is promotional disclosure. So in preparing for today, I pulled up several of our recent continuous disclosure comment letters, and promotional disclosure was raised very commonly. So I would refer you to CSA Staff Notice 51-356, Problematic Promotional Activities by Issuers. It provides some examples of promotional activities we consider to be potentially misleading. Some of these are just overly promotional and subjective language, issuing numerous news releases that disclose no new material facts. We see that a lot. Announcing an issuer name or a business change to reference an emerging industry, like the flavor of the month, like, all these companies talking about AI right now. And so you're doing that, but you actually don't have a supporting business plan for it, and you don't have comprehensive risk disclosure relating to this new business. MD&A disclosure is another common area where we're currently seeing a lot of issues, and a lot of these issues are recurring every year. Related party transactions. So in the MD&A, the issuer must identify the related person or entities. It's not sufficient to simply identify a related party as an officer or a director when there are multiple officers or directors. You have to actually identify which one is the related party. Secondly, use of previous funds raised. An issuer is required to include a comparison in tabular form of disclosure they previously made about how the company was going to use proceeds from any financing. And then you have to also include an explanation of variances, if any, and the impact of those variances on your company's ability to achieve its business objectives. So this disclosure is often missing. And one thing I would say is if we're reviewing a short form prospectus and we see this in the CD, we are going to require disclosure of that use of previous funds in the prospectus itself. A last point on MD&A, significant projects that have not yet generated revenue. Where an issuer has projects that haven't yet generated revenue, which is most of our issuers in BC, they must describe the project, including the plans, the status, expenditures made, and how those relate to timing and costs to take the project to the next stage. Again, this has been quite recently a very weak area of the disclosure. The last point I would raise is on the CSA Staff Notice 51364. This is a review of our continuous disclosure review activities for fiscal 2021 and 2022, but it continues to be relevant. I would encourage you to review it if you haven't already. A couple of the points to highlight, one was already mentioned earlier, was greenwashing continues to be an issue, as well as overly optimistic financial outlooks. So I will now turn it over to Anita to talk about some year-end reminders.
Thanks, Larissa. So while common findings in the prior year are likely to be a good place for you and your clients as you start considering where we might focus our reviews in the upcoming year, I want to give you some year-end reminders as well. And I would like to start with economic uncertainty and the current environment. So in 2023 and into 2024, companies continue to face uncertainty, significant uncertainty, global supply chain issues, labor shortages, conflicts and wars, and general market volatility resulting from market interest rates as well as inflation are indicative of the uncertainty that continues to exist. So how can this uncertainty be reflected in a company's disclosure? The impacts of the company are likely to be reflected in both the MD&A as well as the financial statements. And in addition, you might have other filing obligations as well. For example, material change report if the company went through a material change during the period. Under securities law, a material change is defined as a change in the business, capital, or the business operations or capital of an issuer that's expected to have a significant impact on the price or value of the security. So definitely management judgment is required to determine whether material change has occurred. But getting into some of the MD&A specifics of where your disclosure might be affected, I'll start with the MD&A. As you all know, it's a narrative explanation through the eyes of management of what the financial statements show and do not show. And areas that we'll be looking for disclosure about the current economic environment includes the results of operations. Where we expect companies to discuss the specific factors that have affected their operations during the year. And we do expect this disclosure, to the extent possible, to be quantitative and definitely issuer specific, as this provides more useful information than general qualitative discussion. Other questions you might ask yourself as you're preparing the MD&A include: how have your costs been affected? How have access to financings been affected, including what ends up being the short-term effect to previously disclosed plans and expenditures? Perhaps there's repayments of previously accessed government funding that needs to be considered as well. Of course, liquidity and capital resources will have an effect as well. So including in your discussion expectations around the ability to generate cash and cash equivalents and how that would affect previously disclosed plans, including planned expenditures and milestone payments. And for those of you with debt instruments, if there have been defaults or arrears, include that statement, and as well as any plans to remediate those defaults. In terms of how economic uncertainty will affect your financial information, there are a couple of areas in the accounting standards I want to speak to. From IAS 1, the presentation of financial statements, ensure that there's sufficient disclosure of the amounts and balances that are subject to estimation uncertainty. So these are the amounts that may be significantly change if there are changes in management assumptions. As well, ensure that there's disclosure of management judgment, the judgments management has made in applying accounting policies that have a significant effect on the balance, on the balances recognized in the financial statements. We recognize that issuers are preparing financial information in uncertain times with evolving information, and issuers with similar circumstances can come to different conclusions and judgments. So this is why we're going to be focusing on entity-specific disclosures as we review upcoming filings. In addition to recoverable amounts and ECL's expected credit loss, I had a brain lapse what ECL stood for, expected credit losses. Other areas of disclosure where significant estimation uncertainty and judgments might be affected include going concern assessment, impairment valuations, fair value calculations, revenue recognition, and perhaps even deferred tax recoverability. Speaking of impairment, I do want to talk about how the current economic environment might affect how you consider IAS 36, which is the general impairment standard. And issuers are generally required to test goodwill, intangible assets, non-financial assets whenever there is a trigger or an indicator of impairment. And this is in addition to the annual testing requirements for goodwill, indefinite lived intangible assets, as well as intangible assets not yet ready for use. So given 2023, how 2023 went, examples of triggers that you might have seen include market value declines. Some assets might have sat idle or worse economic performance than expected. So depending on the disclosures that ultimately end up in your financial statements, staff may ask for management's analysis of the impairment indicators or ask for management's impairment tests. So the triggers that I just spoke to, they're outlined in IAS 36, but IFRS 6 also has examples of impairment considerations for exploration and evaluation assets for those of you in the junior mining space. In IFRS 6, E&E assets might be impaired if the period for which the entity has a right to explore has expired or will soon expire, and there's no expectation for renewal, or if there are no significant expenditures planned or budgeted relating to exploration and evaluation. So if an issuer has difficulty obtaining financing, likely staff at the Securities Commission and possibly your auditor as well might ask to see management's analysis of the impairment assessment for E&E assets. So still on accounting, but maybe not necessarily relating to the disclosure effects from the current conditions. I wanted to add on to Larissa's comments about and highlight some of the accounting specific issues that could fall out of some of the transactions that we're seeing where securities analysts have raised comments. So about significant acquisitions, from an accounting perspective, we do continue to raise quite a number of comments relating to intangible assets, especially those acquired during the reporting period under review. Specifically, we've raised questions about whether the expenditure meets the recognition criteria in IAS 38 to be accounted for as an intangible. Such criteria includes that the asset is separable and identifiable, and whether the entity has control, which is the power to obtain future economic benefits from that asset. And relatedly, whether there is a basis for expecting that there are future economic benefits from that asset. So an example where we would raise questions about whether any of the recognition criteria has been met, it's not uncommon to see an issuer recognize costs relating to an application only. So we have an entity who acquires another company who's in the process of applying for a license or a patent, and they don't have that patent or license yet. In that case, when they recognize the acquisition cost as an intangible, staff will likely raise comments about whether there is a separate asset that the entity controls from which they could obtain future economic benefit. So we're really going to be looking at the underlying agreements to understand the rights acquired, and if the contract isn't filed as part of the material contracts, then it might be something that staff will ask for as well. And for intangibles that are recognized, I've mentioned this before in prior years, but we may also have questions about the fair value attributable to the assets acquired. We continue to see share-based transactions in this area, as Larissa related to, and for related party transactions, exchange value may not be indicative of fair value since the transaction isn't between market participants. However, related party exchange amount can be an input into fair value determination, but this might mean, but only if the entity has evidence that the transaction was entered into at market terms. So this might mean that an independent valuation with assumptions that are reasonable might be necessary, and we may ask questions about how the company determined that the related party transaction amount was at market terms. And for significant transactions between related parties, we're also asking questions about how the company determined the exchange amount. So we're not talking about the deemed price of a share. You could refer to a trading price or maybe a recently completed private placement. But how did the company determine the right number of shares to issue? What was the due diligence that the company did prior to the transaction? Impairment I touched on more generally, but we are continuing to see a similar fact pattern play out where the acquisition of a set of assets relates to the net assets acquired. The majority of the amount is recognized as some sort of intangible. They're usually share-based transactions, and oftentimes we see impairments taken at year end, but it is important for issuers to consider whether there's actually a day two impairment. So part of our questions might revolve around asking for management's assessment and analysis of whether there were triggers for impairment prior to the year end, and if so, what were management's assumptions in calculating recoverable amount or value in use. Note that IOSCO, the International Organization of Securities Commissions, recently also published a notice relating to impairment. It does relate to goodwill, but I think the point is relevant. The notice noted that investors raised concerns on the timeliness of impairments taken, given that the overall balance of goodwill has grown to such a significant portion of entities' balance sheets on a worldwide scale. The number cited is it's currently at 30 to 40% of issuers' equity across all the IOSCO jurisdictions. So unchanged balances of goodwill and intangibles over multiple reporting periods may trigger comments as well. We also raised comments last year about inadequate disclosures around whether, conclusions about whether an acquisition constituted a business or a net asset acquisition. And when it was a business combination, staff will likely look at the purchase price allocation, and if a significant amount of consideration was allocated to goodwill, this might indicate that not all separable intangible assets were properly identified or measured. So we might raise a comment about this as well. Another financial reporting related item that we track are change of auditor filings. So we monitor and look for trends, like as Carol mentioned, that is something that we're hearing from our marketplace. So we do track change of auditor notices. And I think it's a good time to remind everyone that there are separate requirements upon auditor termination as well as upon auditor appointment. So it could be the case if you don't have a successor auditor named at the same time of auditor termination that you end up filing two separate change of auditor notices. I don't have too much time to go into details, but there's been some amendments to IAS 1 recently that could affect how your financial statements will look. So I encourage you to reach out to me afterwards or your contact at Davidson if you have more questions. The first one is an update to IAS 1 as well as IFRS Practice Statement 2 that requires now the disclosure of material accounting policy information, which now previously the requirement was disclosure of significant accounting policies. It is meant to be more than a find replace exercise of significant to material, and I've outlined a three-step approach on this slide. Another change that was issued in October 2022 related to the classification of liabilities as current and non-current, and this amendment clarified that only covenants with which the entity had to comply with at the reporting date or before would affect the classification. The IFRS discussion group, it's an advisory committee to the Accounting Standards Board in Canada, and they actually discuss various scenarios, applying various fact patterns relating to these amendments. So if your entity or your client has debt, I encourage you to access the meeting topic summaries. It's on a different slide, which I'll get to. The reference to the website is on a different slide because I speak to it later. And one thing that I'm personally vested or tracking is upcoming publication of IFRS 18. So this is going to replace IAS 1, which is a presentation standard of financial statements. Among other things, it will require disclosure of two defined new subtotals, but the other requirement that I'm focusing on is the disclosures relating to management specified performance measures. So these management performance measures are a subset of what we would call non-GAAP financial measures or possibly supplementary financial measures. So to the extent that there are overlapping requirements, we will be looking at the amendments at the new standard to ensure that the standard and our rules work together to provide useful financial information to our issuers. And then here's the link to the IFRS discussion group topics that I referred to earlier. It's a very good resource for non-authoritative guidance. A lot of the topics that are discussed are for awareness raising. For example, there have been many discussions on crypto. In 2023, there were 3 separate discussions on accounting relating to carbon credits. So emerging topics are discussed at the IFRS as well. I do highlight 2 that I think are prevalent for the BC venture market relating to indirect earn-in arrangements, accounting for those costs prior to the entity obtaining 100% of the mineral property interest, as well as share for debt transactions and the accounting implications, depending on whether the shareholder creditor is acting in a capacity as a shareholder or as a creditor.
In November 2022, we adopted the listed issuer financing exemption. Briefly, it's an exemption for listed issuers where they can raise about $5 to $10 million per year, subject to a number of conditions, including providing a short offering document. The securities issuable under it are free trading. So to date, it's been quite successful in that 100 BC issuers have raised about $310 million. Nationally, it's about 160 issuers have raised $525 million. So early last summer, we published frequently asked questions. It's CSA Staff Notice 45-330. If you're planning on using the exemption, I would strongly suggest reading those FAQs. Now, there is no regulatory review before using the life exemption. However, we are doing a very, very high-level scan of a lot of the offering documents just to make sure there's material compliance. And we have issued compliance letters on a few offerings where it appeared that the offering document did not, or the offering did not meet the conditions of the exemption. So a couple of the areas that the problem areas we've seen, one is on available funds. One of the conditions of the exemption is that at the time of the distribution, that is the closing of the offering, the issuer must reasonably expect that it will have available funds to meet its business objectives and liquidity requirements for a period of 12 months following the distribution, which is very similar to the requirement under the prospectus that I just talked about earlier. So we will raise issues on a life offering if it appears clear that the issuer does not have sufficient available funds at the time of the offering document, for instance, a significant working capital deficiency, and at the same time, there's no minimum offering amount for the life offering. So an issuer could usually meet this condition if they set an appropriate minimum offering amount. A second recent common issue is including revenue projections. So in the available funds table of the offering document, there is a line for issuers to include additional sources of funding. In our FAQs, we clarify that additional funding must be committed to be considered. So for instance, a couple examples we provided were like a concurrent bought deal private placement or a established credit facility. However, we've seen issuers include revenue projections as part of the additional funding, and this is problematic because there's typically no certainty that they will receive this revenue. Furthermore, they often aren't complying with the forward-looking information requirements in Section 4A of 51-102. There must be a reasonable basis for the projections, as well as disclosure for the material risk factors and the material factors and assumptions that were used to develop those projections. The last point is something that's come up multiple times. The issuer needs to certify at the end of the document that the offering document and any other document filed within the last 12 months contains disclosure of all material facts and does not contain a misrepresentation. So issuers need to put in the date that's 12 months before the date of the offering documents, but recently we see that issuers are putting in the current date, which means they're not actually certifying any of their previous disclosures. So when we see that, we will go back and make them change it before they close the offering to make sure they're actually certifying the appropriate disclosure. Just briefly, another regulatory update on what we call APIN, Administrative Penalty Imposed by Notice. This is a new enforcement tool at the BCSC. We can now issue a written notice requiring a person to pay an administrative penalty for contravening a regulation. So it's not for breaches, currently it's not for breaches of the Act or for more serious offenses for which a hearing or other sanctions would be more appropriate. This is a tool aimed at breaches of regulations, such as securities rules. For instance, like 51-102 would be an example where we might use this tool in the future. The max penalties are $100,000 for individuals and $500,000 for non-individuals. Another quick update, BCSC now has a whistleblower program. You might have seen it in the news. As part of this, we have a secure website for whistleblower tips. If you provide a tip, you could be eligible for financial awards of anywhere from $1,000 to $500,000 if the tip leads to an enforcement award, and I think the amount is dependent on the nature of the tip. So the tip must relate to fraud or serious misconduct in BC or to victims in BC. It must be related to securities, and you can't be a whistleblower for your own wrongdoing. There are other avenues for self-reporting. I will turn it back to Anita for the last of the regulatory updates.
All right, everyone, home stretch from the Securities Commission. So one thing that the Corporate Finance Division also does, we collaborate with our Canada's other security regulators across the various provinces to set requirements that balance investor protection with cost-effective access to capital. So one project I want to start on, and Carol alluded to, is that we were developing a consultation paper on the prevention and detection of fraud, and specifically on, as well as errors in the financial statements, and specifically the role of financial literacy of audit committees, the existence of whistleblowing procedures, and the existence of an internal audit function in fraud prevention and detection. One item that we found with discussions with various parties about financial fraud was that audit committees play a critical role in fraud prevention and detection, which led us to do further work about the audit committee requirements in Canada. So this included reviewing academic research on the linkage between financial literacy of an audit committee and financial reporting outcomes, as well as comparing our current requirements with those in other jurisdictions. We looked at Australia, UK, the SEC, and Europe. The areas that we'll be exploring in the consultation paper are listed on this slide, but maybe I'll speak a little bit about financial literacy. The academic research that we looked at showed a correlation between decreased earnings management and misstatements and the presence of financial expertise on an audit committee. And based on our own experience reviewing financial statements and monitoring developments in accounting and auditing standards, we thought the financial literacy closely related to an audit committee's ability to prevent and detect misstatements in the financial statements, whether due to fraud or error. For example, errors could result from increasing complexity of accounting standards or entities entering into new industries where if it's not clear that, if there's not a full understanding of the transaction streams and the business model, audit committee members might not be equipped to detect misstatements, whether due to fraud or error. And in Canada, under our current securities requirements, venture issuer audit committee members are not required to have financial literacy. And other jurisdictions we noted had at least explicit guidance or best practices for smaller public companies. So this is an area that we'll be exploring in our consultation paper, as well as these other ones listed above. We're planning to publish it later this spring, so to consider whether amendments to our rules or changes to our policies is necessary. So I hope you'll come back next year and I have an update for you on this project. And finally, another project we're working on with our colleagues is developing climate-related requirements in a separate rule. While work continues on this project, I think this is a good time to remind everyone in the room that several of our current regulatory rules already contain disclosure requirements relating to environmental matters. The MD&A, of course, requires an analysis of events and activities that occurred or are likely to occur that can affect your financial performance, position, or cash flows, as well as discussion of uncertainties and commitments. So these could, of course, include climate-related matters. In addition, various of our continuous disclosure requirements speak to risk factor discussion. So the risk factors that relate to financial and operational effects of environmental protection policies or other social and environmental regimes. These, if material, are already required to be disclosed as a risk factor as well. So I've listed out the guidance, the staff notices where we provide the guidance on the existing requirements relating to climate-related matters. I know we're short on time, so maybe I'll just mention that from the Chief Accountant's Office, there is a connection between sustainability-related disclosures and the financial reporting and the financial statements. For example, the sustainability standards that are proposed require that the assumptions used to develop those disclosures are consistent with those used in the financial statements. And as well, there are requirements in the existing IFRS accounting standards that could be relevant when considering climate-related matters. For example, the useful lives of PP&E, and whether due to changing consumer demand, inventory might be obsolete. So the International Accounting Standards Board issued this guidance document actually of areas that you would currently consider where you would consider climate-related issuers currently in your financial disclosure. And with that, I think I've taken up more than our share of the time, so I'm going to pass it virtually on to Andy for his stock exchange update.
Hi, everybody, and thank you to Davidson and Company for the opportunity. Sorry I couldn't be there today in person, but with the snowmageddon, I thought a fireside chat would be in order. So grab some caffeine, as you'll likely need it, and circle around. We're going to cover 4 main topics today. We're going to talk a little bit about a BD update, then go through the market statistics, and then cover venture forward and some policy changes. So first up is some business development. Last year, we actually launched a new full-time employee, dedicated staff member on the ground, Luke Alshorn, and he's based in Sydney. He covers all of Australia and Southern Asia. Overall, we have 23 issuers so far, and 13 are interlisted with ASX. The CPC program in Australia is not that well known, but it's of interest in particular to the life sciences space down in that continent. We have a Brisbane-based company that did complete a QT and has done 4 subsequent financings since 2021. So some life down there. And also recently we've had a Melbourne company in the life sciences space sign up for a QT as well with the CPC. Some other BD activities we do, the US Roadshow, I've probably mentioned this a little bit before, but Delilah is based in California and George is based in Chicago, and they both organize probably about 3 to 5 events. We also have Eric in Austin, Texas. So we have 66 new listings over the past 5 years from the US. Those issuers have raised $6.7 billion in aggregate. We're pushing for establishing more US-based CPCs and connect those US companies to Canadian deal makers. There's been a fair bit of success by our BD heads in the US to generate private companies looking to access public markets. So for the deal makers in the room, I'm happy to connect you with Delilah, George, and Eric. And yeah, the companies down there are generally fairly diverse: real estate, med tech, clean tech, digital assets, a large variety of issuers down there. And these roadshows are a speed dating type activity. So there's usually 7 or 8 private companies looking to go public. We'll bring a couple law firms, an accounting firm. Gonna have to work on Erez to get Davidson down on one of these things, and get and then work that room for the day, and then a couple other events where there's good opportunity to network with people down there. Similarly, there's Deal Portal. So this isn't US centric, it's just the Deal Portal. It has all the general deal flow from the TSX and TSX Venture Business Development team globally. So companies that are interested in going public post their slide decks to the Deal Portal. We've had about 40 year to date as of end of October 2023. Posted to the Deal Portal, and it's a place where CPC founders and Canadian deal makers can access to see who's interested in going public and potentially working with those entities to go further. And if there's anybody that wants to get signed up for that, let me know, and I can help you get connected for that too. Just similarly on that Deal Portal, there was basically already we have 690 issuers signed up for that, and not issuers, CPC founders and deal makers, and there's over at least 200 bankers on that platform as well. Next, we've got NASDAQ. We've seen a bit of a trend for some Canadian companies doing IPOs direct to NASDAQ, and they're relatively small for TSX. For TSX venture companies, or companies that in theory would be listing on venture or TSX, about $15 million IPO range. Left column are stats for TSX venture issuers that added NASDAQ capital markets listing, and the right column are for Canadian issuers that bypassed Canada and went direct. Basically, it's saying that it's been rough for issuers to list on NASDAQ. 15 million isn't quite enough to cover all the costs that they have down there, and there's an immediate negative impact on the share price, and almost every issuer has to do a consolidation down there. It's over 50% for sure. It's largely due to the added regulation. There's a minimum share price to maintain the listing on NASDAQ, so there's a lot of pressure there, and then just the costs around maintaining that regulation as well. Next, we're on to the market update. And I know what you're thinking here. There's lots of numbers, and as Derek Zoolander would say, what is this, a slide for ants? It needs to be at least 5 times this size. I'm told the slides will be made available after today's session, so I'm leaving this one in here in case you want to refer to it later. The next few slides cover off the main points here from now from our market intelligence report. So first up is issuers by region. There's no surprises here, as the bulk of the TSX venture-based issuers are in BC and Alberta on the left side, and TSX is in Ontario, the middle chart there. That's going pretty high. What's cool is though that the US now registers on its own, and it's at the far right side. So we're looking to grow that side of the business for sure. Overall, TSX increased issuers year over year, 20 new issuers, mainly on the ETF side. So they're at 1,800 overall. TSX-V decreased 30 issuers year over year, mostly as a result of less CPCs getting formed this year. We're at 1,670 issuers overall. In terms of equity capital raised, so money raised, it was a tough year for sure. TSX Venture was down 27% to 4.3 billion. TSX was down 20% to 17.1 billion. Mining held up relatively steady on the far right side over the past 4 years. Energy sector was the strongest last year. It's the second from the left, so it had a decent spike there. And then weakest last year was in the innovation and diversified sectors. In terms of number of financings, mining is on the far right side again. It actually increased year over year. So true to the TSX-V survival with working capital financings, there was more number of financings raising less dollars. So that's why there was the drop in the cash raised. Battery metals to start the year and clean tech drove the general volume of financings early in the year. Lately, it's been some uranium companies. In terms of volume of new listings, TSX Venture across the board, it was a challenge. We had a drop of about 47% year over year in terms of new listings. Most of that was on the CPC side of things. We had an aggregate of 86 new listings overall. Most of those were in the mining sector. There was only 2 IPOs last year on the venture. TSX actually increased 19% overall. Again, mostly on the ETF side. They had an aggregate of 135 new listings. And there were 12 grads to TSX versus 16 year over year. In terms of trading volume, the energy, financial services, and mining industries were relatively steady for volumes. There was drops in volume for both diversified and innovation side of things. So a consistent theme there. In terms of TSX market update, some of the bigger items there is T+1 settlement is coming in May of 2024, and that's market wide across North America. So all the markets will be adjusting for a T+1 settlement. There was a large amount in terms of financings. There was a large amount of debt financings and refinancings that happened this year on TSX. And then the life financing exemption, we mentioned that last year. It was introduced by CSA in late 2022. It's received a lot of positive feedback so far. Okay, switching gears to Venture Forward, next chapter of the presentation. In June of 2022, we launched a white paper where we sought extensive stakeholder engagement. We did surveys, group discussions, one-on-ones, local advisory committees, national advisory committee discussion around what could make the marketplace better and stronger moving forward. And the feedback overall was, stakeholders were looking to accelerate the TSX Venture process without compromising our standards, and also more opportunities to showcase issuers to investors and grow the investor base. So the results, as a result of those discussions in the white paper, we came up with 4 main commitments. One was for a passport listing process, and there'll be more to come on that today. In terms of the second one, there was digital transformation. So we have links and are continuing to build that out. It's our online filing system, and that'll be coming in 2024. It's available for use now on a voluntary basis, but we'll be transitioning to that on a sometime in 2024 where every issuer needs to be making filings through that system. And the theory there is that the online system facilitates and does a fair bit of work for the filing to simplify the filing process. Third one is this TSX-V sandbox, contemplating that for listings, and that would be for listings that don't meet all the listing criteria. Also, we're evaluating the need for a new differentiated market. That one's more long-term and is being evaluated, and they're looking at all different types of ideas around whether a new market is required. So circling back to the first one of those four, the TSX-V passport listing process, I'm excited to say that it's now live. We launched in December, and I led the team that developed the criteria and process to help advanced stage applicants move through the listing process on a fast track basis. We'll go through the criteria and process over the next 6 to 8 slides. Overall, the passport listing process will bring increased efficiencies, accelerate the transaction review time, and decrease costs, including deal risk. We've heard multiple times that when money is on the table, the financing windows are tight. So we developed this to try to help companies go public quicker to hit that financing window. The criteria and process we're going to be talking about for the passport listing process is not new initial listing requirements. And it's also just designed for approximately 10% deal flow. So we're keeping it to the advanced stage issuers to start, and hopefully with time, best practices that fall out of this review process transition to all new listings. Okay, so what are the criteria? Passport listing criteria, you have to meet all of the initial listing requirements without waivers. Applicants need to have a minimum unallocated of $500,000 versus $100,000. Again, this is not new initial listing requirements. This is more what makes an issuer easier to get through the system. We're not reducing the amount of work we do. We're trying to coordinate arranging all the information up front such that when it comes into the top of the chute, we can just continue on the bobsled track down and move the file through the system as quick as we can. For evidence of value, either a $10 million concurrent financing or a market cap for the resulting issuer of $50 million or higher, and either $5 million in revenue or a 10% concurrent financing. In terms of the criteria as well, we need financial statements. These have a potential to be a big time delay if there are financial statements such as predecessor financial statements that are identified halfway through the process. Then people have to take a month or two to try and prepare those financial statements on a rush basis. And as we all know, it's difficult to get an auditor to help with that at this time. So it's best to deal with any sort of financial statement issues up front to identify what's required and what level of review audit as well. For public distribution, the public distribution can't be created via a cloning transaction. That lends itself to a fair bit of issues and time delays around that, and usually hold periods around that artificially cloned distribution as well. For there to be eligible, it can't be a related party transaction, so no 61-101 transactions there for the main acquisition agreement. Just continuing with the criteria, the directors and officers, the majority have to have at least 2 years of experience either on TSX or TSX-V as a director and officer, and that's majority, not each director and officer. Similarly, the CFO should be a CPA or at least 2 years experience as a CFO of PubCo. And the majority of the directors and officers need to be residents of either Canada or the US. So again, similarly, we're taking, based on experience reviewing these transactions, what are the types of transactions that lend itself to moving through the system fairly quickly? Let's put that together, and that's kind of how we came up with that criteria. From time to time, we do have issuers that are excluded resource issuers. So to be eligible for passport, you can't be an emerging market issuer, but you can be an excluded resource issuer. That means basically, look, if you have a fully foreign principal asset and fully foreign directors and officers with foreign searches in a jurisdiction we're not that familiar with, those are not passport eligible. But if it is a resource company with operations in a foreign jurisdiction, but with predominantly North American board of directors and officers, that happens a fair bit on our exchange. We didn't want to exclude those, so those are still eligible. Comprehensive news release needs to be available as well. And obviously we're going to want to have a pre-file meeting with the applicant as well. So with all that documentation, basically you'd file a letter with us or an email outlining how you meet all of those criteria, ask for a pre-file submission letter, pre-file meeting with us. And then within 3 days of that pre-file meeting, we'll confirm whether the applicant is eligible to file under the passport listing process. Okay, so that was all criteria. Now we're switching to the process. Again, this is for advanced stage applicants. So there's a lot of work that has been done prior to applying to list with us. We do have companies that apply to list and they'll send a check report and nothing else, or they will send a Form 2J security holder information sheet and nothing else. And if we're lucky, sometimes we get both of those, but we're still missing a disclosure document. The TSX-V passport listing process is designed for those companies that have all of their documents in order. So we need a complete submission up front. The issuer needs to sign up for TMX links. We need a comprehensive filing letter. There is a sample available. We created a new passport process website, so the sample letter is on the website. We'll need the draft disclosure document, whether it's the information circular or the filing statement. And we'll also need the financial statements that you have available. So generally you should have the prior audits available at a minimum to make that initial filing, and the interims can follow in due course. In terms of the process continued, we'll also need the Form 2J security holder information completed, tech reports if it's a mining issuer or oil and gas issuer, and all the personal information forms need to be filed with us as well. So they just need to be filed with us to apply. We can run the background searches in the background. And in general, foreign searches, at one point in time, were taking a long period of time to get cleared. We've made some serious headway in that. So it's usually foreign searches are taking less than 4 weeks at this point in time. We'll obviously need a copy of the material agreements that are being filed to review the documents in connection with the passport application, draft title opinions. Title opinions can also be a time delay or a source of time delay during the process. We don't need the final draft, or sorry, the final title opinions, but in order to move through fairly quickly, we'll definitely need an initial cut of the title opinions for the project when you make the initial submission. Within 5 to 7 days of receiving so our commitment is within 5 to 7 days of receiving all of the documents above, we'll provide the first comment letter, and we'll also schedule biweekly status updates calls with the working group as well. And we're definitely striving to support the growth and success of all applicants, and this process will not interfere with other applicants. And if anything, will lead to best practices that should improve the listing experience for all applicants. And just as a follow-up to that, we launched in December, and we already have one applicant that is seeking to list on the passport basis. So it's been well received so far. And if you have questions around that process, happy to talk with you and your deal team around any potential listing you may have on that basis, and any new listing as well. But just to explain this new process. In terms of policy updates, we'll talk about TSX first and then into TSX Venture. For TSX, they've had a few different changes this year. They put out notice on pricing on public offerings. Basically, they clarified when certain prospectus offerings are private placements. And that's also read as they made changes to deal with the life exemption financings. And technically, the life exemption is is a financing exemption, and TSX put out clarification around that aspect. Maintaining a listing that focuses on the guide to timely disclosure, and then voting agreements. In general, it's okay to have voting agreements if the disinterested shareholders approval is obtained in advance for that voting agreement, or if that voting agreement allows for the voter to abstain. Those two situations are generally okay for TSX to allow for voting agreements. And again, that's TSX, not TSX Venture. And then lastly, T+1 is coming for all markets as noted before, May 27th, 2024. In terms of venture policy changes, we put out a notice for private placements of flow-throughs with charities. And basically, we need a prospectus exemption for all parties at all stages. And also reminding issuers that they should consider any 61 and 101 implications for all the parties at all the stages. And we do need the list of the initial and the end purchasers in the Form 4B, and personal information forms for any 10% shareholder. And there's a possibility for shareholder approval for any new 20% shareholder. Similarly, we put out a notice for CDR Plus and CPCs. CDR Plus, if you are making a CPC filing, that does have to go through CDR Plus, and that gets to the CSA. But as of yet, CDR Plus doesn't have that capability to also file that with us, so you would need to also file directly with TSX Venture Exchange. You can submit the documents through links. Or we actually moved the Vancouver office in August this year. So if you're coming in for a pre-file meeting, we're in the building next door now, no longer in Scotiabank Tower there. We're right next door in VC2. And Form 2J, we actually updated it this week. So the new form is posted online. And TSX-V passport listing process is live, and T+1 is coming. With that, I also just wanted to say that if for whatever reason you can't get a hold of me for a Vancouver-based filing, we also have Janice Harrington in Vancouver, and she's in charge of the team that's handling private placements, shares for debts, acquisitions, share-based compensations, and loans. So feel free to give her a call as well. But yeah, thanks for the opportunity. Great to see you, and have a great day. Thank you.
Thanks a lot to everybody. First off, to CPAB, to Carol and Haiti. I didn't know it's been 20 years. I remember being inspected 20 years ago. But it's quite great to see the evolution of CPAB over the years, and particularly over the last, I'd say, 5-6 years, where it really began with just inspections, and now you've evolved to other parts and stakeholder engagement and thought leadership. And we remember what inspections were like then versus now, and sort of your involvement or risk-based approach, as well as you've listened to others about desiring to have contact with investors and stakeholders in our community. So we think that's been really good. And then also, the actions that you've taken for auditing firms have been quite measured, different things for different firms and different size firms. So we think that's quite commendable as opposed to a one-size-fits-all. And so what we're going to do here, I think we have about, and then to the BCSC, your ability to talk to companies and reporting issuers and being available to them when they have questions, and some of the challenges that you've named about businesses, impairments, short reporting periods, just your ability to be there has been great. And then, of course, with the TSX Venture, the expansion of business across the US and international, and sort of the marketing to bring companies to Canada. So we look at it all as a whole, and know why Canada remains such a wonderful environment to be able to go public in a way where all professionals and all stakeholders are involved in creating a good, healthy public company system. So with that, since we probably only have maybe about 10 minutes or so, what I'm going to do, if it's okay with everybody, I'm just going to ask you one question each. Keep it relatively lighthearted. They don't know what the questions are, and I'm trying to make them too difficult. And I was trying to look up Andy's cell phone number, but I might not embarrass him now in case he's on to doing something else. But I don't know if he's got my cell, so he might not be able to pick up anyways. But Danny, I don't know if you want to ping him. We might not be able to hear him, but you got a cell phone there, Danny? And maybe have it handy, and maybe last minute we'll call him, see if he wants to say hi, but maybe give him a heads up. I was trying to look up his cell, but something happened with my email that didn't quite work. So, Carol, if I could start with you, I know you sit on the, the international panel for regulators, and as much as you can comment, are the challenges that you see here in Canada the same or different than other comparable countries, or can you name any differences of what other audit regulators see versus what we see here in the country?
A lot of the topics that we speak about are very, very similar across other jurisdictions. It does vary depending on the nature of the markets. So, for example, we had many more public crypto companies over a period of sort of the last 5 or 6 years. And some jurisdictions, that was quite a bit slower to occur in the public marketplaces. It does vary also if you're not in the developed nations, you may not have the same issues regarding resources available and the high level of retirements and other topics. So we do learn a lot from our fellow regulators in other parts of the world. Sometimes they will address an issue like we're seeing with the climate-related disclosures before we are getting into the reporting side of it.
Okay. So yeah, obviously it depends on the jurisdictions, but we find too with our affiliation as part of Nexia, when we talk to a lot of firms globally, it's not that different. I mean, obviously different countries will have different challenges, but it's quite amazing how a lot of things that we see here at home are not that different abroad either. And Haiti, if I could, one for you, one of the comments either you or Carol said is that Canada has the half amount of findings compared to the rest of the world in general. And we'd like to believe that it's a combination of good regulation and good mindset of Canadians to try to do the right thing. Is there anything that you've seen or could comment on why Canada does to fare a little bit better than globally? Or if that's a Carol question, feel free to as well. Is it? Okay.
And to be fair to Haiti, she isn't on the same board as I am. So we do benefit from being beside the U.S. and their integrated audit, the SOX environment that you have there has resulted in stronger processes and controls at the public companies, the reporting issuers.
Yeah.
So that's one of the fundamental differences that you see compared to other markets and what we encounter in audits. I think it's also a testament to the people in Canada, the training that's provided, all of the good companies like yours in terms of the work that they do, that we have had a strong standard in our ecosystem in a number of areas.
Okay, great. Haiti, don't think we're escaping you here. I think one of the things that you mentioned, Haiti, is about, I think 90% of the reporting issuers in Canada are, I think, audited by 13 firms or so. Now, one of the things that we find sometimes challenging is at our firm, and perhaps the national firms would say the same thing about us, is that when audits go to smaller firms, whether it be for fees or so forth, and we understand it's not a significant part of the market, but what are the challenges about sort of that 10% being audited by smaller issuers where inspections are not as frequent given the number of reporting issues? How do we address that, and what do you see there?
No, thanks, Erez. And we certainly, we monitor all auditor changes really closely. And, through our risk sensing and our risk database analysis, if there is something in a reporting issue that may now be audited by a different category of firms, so for example in this case outside of the other annuals, we would go in and inspect that firm.
Okay, so you would do a particular inspection from a particular file, even if it's not an annual. So
yes,
and you do that by way of monitoring of the change of auditors and
Yes.
Okay, so that you do cover the 10%. just not necessarily on an annual basis and so forth.
That is correct,
Okay,
yes.
okay, thanks for that. Now I'll turn it over to Larissa, if I could, for a moment. You talked about how a lot of companies, when filing prospectuses, sometimes don't meet the financial statements requirement, and particularly about short periods.
Yes.
And we get that question a lot from clients, where they set up a new entity, vended a business in, maybe from another company, or whatever circumstances they might be, they're only auditable for, say. So is there a rule that talks about the length of period of time, or is it a judgment call?
There, in the guidance to, I think it was section 5.5 of 41-101 CP, we do talk about that if you've got less than a year, if your audited annual financials are less than a year, then if there's not additional information, like disclosure, then we may require, like it may be a public interest thing, and we might require a longer audited period. So that's really where it comes from.
Yeah.
That we would kind of point to that.
Yeah. And then what we've seen, of course, if there's shorter periods, sometimes you look at things like carve-out financial statements, which I don't know if you could really briefly in layman's term describe what a carve-out financial statement is.
I mean, I would give
Or
that
to
to
Anita.
you.
Okay. Give the account in the room.
Yeah, and you could correct me, but in addition to the CP guidance, I think in the form, for, the prospectus form itself, there is an explicit requirement that if you acquire an entity, you have to have enough periods like put together over a year to kind of satisfy the sufficient financial history. I forget, 30, I'm going to say the wrong number, so I won't say it, but there is something specific. But in terms of carve-out financial statements, I think we treat the reporting entity how the IFRS accounting standards and the conceptual framework, so ensuring that the boundary makes sense. And in that case, it might not be a legal entity as well. So if the business being vended somewhere else can be carved out, we would expect, I think, for most cases, carve-out financial statements to illustrate the sufficient financial history related to that business that's going public.
Right, because sometimes it doesn't actually, you said it doesn't have to be a legal entity,
Correct.
right? So what would you call it? Can they just name it what they would like?
We've seen it. We think we've seen carved out net assets being acquired by.
Okay. So just
Explicit-
describe as best you can as what it
explicit
is if
language
it's
is
not a legal
helpful.
entity.
And, everything's facts and circumstances specific. So,
Yeah.
But
Okay.
I think we're very open to having discussions if there's something interesting, what helps us gets us through our day as well. So.
Okay. And Larissa, if I could put you on the spot for a moment,
Sure.
but when you select continued disclosures, is there a method of how you choose client reporting issuers?
There's a number of different factors that might come into it. So it might be a referral from another group. It might be a complaint. It could just be certain risk factors. There's a number of different things that we might look at for particular issuers. So I wouldn't say you can't really predict. Although if maybe you have a client and we're raising certain issues and you have another client with the same issues, you might see something, but.
Is every reporting issue subject to review every so often, or there isn't like a specific thing? Like I remember at some point in time, the SEC, for example, I think had a rule every 3 years they would look. I might be misquoting it.
We don't have that in BC. I'm not sure of other jurisdictions in Canada, but we are more, I guess, risk-based for our CD reviews.
Okay. Thanks for answering that on-the-spot question, Larissa. And just finally for you, Anita, you talked about day two impairment. So one of the biggest challenges we're counter-facing right now as a firm is that we often see technology companies, and as you mentioned, a lot of the acquisitions are share-based as opposed to cash, and sometimes it's tied to a financing price. Sometimes it's just, and so we end up getting large material numbers, especially in the venture companies where stocks fluctuate a lot, and then we're struggling with a big number and how to test for impairment. And so this day two impairment concept, which is really tough for accountants to swallow, because you acquire something for $10 million and the next day you say, well, it's worth less.
Yes.
And we often, well, what changed, or now of course there's a fraud risk that they might have related party transactions, for example, where auditors have to look beyond that. But have you seen a lot of day 2 impairments?
I think I think you hit the question on how we don't see day 2 impairments, we see day, I don't know, 250 impairments, right?
Yeah.
So
Right.
somewhere between 2 and the end of the year, that's when we think an impairment or a trigger for further testing should have happened. And we do treat it more from kind of an overall disclosure, more from a material change aspect. And the accounting is of course related to that as well, because that's what investors focus on, the number right away. But no, you're right, like how you phrase that is exactly how we struggle with. Like who knew what when is something we say a lot in our offices, and that's very hard to pin down. So it does go to ensuring that you have your judgments, your ducks in order, your memos and your analysis in terms of how that value is supported, why the accounting makes sense, and what changed at year end that triggered the impairment.
Right.
So.
Okay. So, I mean, the main concern is like fraud, related party transactions, something unusual that somebody would have done that's not. Is that fair to say?
I think so, but I think generally the promotional aspect
Yeah.
of a large asset that actually has no future economic benefit, like
Yeah.
that's not necessarily fraud. It just might be
Yeah.
promotional and misleading. So I think there's various aspects.
Okay. Okay.
to
Great.
it.
What do you think, Daniel? Are we going to call Andy or? Do you want to come up here for a second, Daniel? Can I embarrass you for a little moment? We just want to see if he picks up. Just maybe give him a call, and then we'll pretty much wrap it up here. If he's not there, that's okay. Just a little bit ad hoc.
Hello, Andy speaking.
Hi, Andy speaking. It's Erez phoning from Davidson and Company. How are you?
Hey, buddy. Good, how are you?
Yeah, we're just in front of about 500 people, so don't say anything negative about us, okay? We just wanted to thank you for your presentation, Andy. We just listened to it. We missed you, and then it looks like you were having fun in your. We just want to know if that's your house or whether or not that was a virtual background.
I'd love to say that was my house, but no, that was virtual.
Okay. All right. Okay. Thanks a lot, Andy. I won't try to embarrass you any further here. We miss you, and thanks for always supporting us here.
I miss you guys too. Yeah, sorry I couldn't be there.
That's okay, Andy. Okay, cheers. Talk to you later. Okay,
Yeah.
bye. Bye. Okay, everybody, I think we pretty much are good for 2 hours. Thanks again for all of the few people who showed up here, and everybody who's going to be watching this that support our firm. Thanks again to all the speakers who have made it here today, and they're taking time away from their daily schedule to participate in this. Again, you could always look at our website for any upcoming events. Please follow us on LinkedIn, email us suggestions, and have a great rest of your month, and all the best for 2024. Thanks a lot.